Hi, welcome to this my 8th data update for 2025. Don't worry, I'm almost done with these data updates. There's one more left to go. But in this one, I want to focus on debt. And debt is an issue that I think pulls people in two directions. And here's why. For as long as we've been on the face of the earth, every religion is inveighed against the use of debt. Why? Because borrowing money can get people into trouble. At the same time, every religion also reserves its greatest invective for the people who lend money out because they get other people into trouble. So if you look at religious edicts, generally they encourage you to borrow less money. At the same time, at least for the last century, governments have encouraged the use of debt, especially on the part of businesses, because they believe that using more debt increases growth, improves the economy. How do they encourage the use of debt? By writing the tax laws to benefit the use of debt. In this session, I want to look at that push and pull of debt because that's going to lead different businesses to borrow different amounts of money. And you're going to see this play out across sectors, across regions around the world in 2024. Before we look at the numbers, though, I think it does make sense to set some fundamentals in play. First, let's draw a line between what comprises debt and what makes for equity. I'm going to use a structure you're familiar with by this point in time with my session. It's a financial balance sheet. When you start a business, there are only two ways you can fund the business. You can borrow the money, or use your own money. Borrowed money is debt, your own money is equity, and here are the key distinctions. The biggest distinction is in the nature of the cash flow claim you have with each of these sources of capital. When you lend money, you get a contractual claim on the cash flows, interest payments and principal payments. With equity, you get whatever's left over, residual claim. With taxes, as I argued in much of the world with debt, you get a tax advantage in the form of interest expenses being tax deductible. In much of the world, equity doesn't get an equivalent advantage. And finally, in return for getting a residual claim, equity investors usually get the lion's share of the control of a business. They get to run the business and make the big decisions. So when you look at a balance sheet, it's actually a good idea to go down line item by line item, putting line items into the two buckets, because accountants are not always consistent in what they call debt on a balance sheet. With that line drawn, let's talk about what causes companies to borrow money or choose not to borrow money. I'm going to start with dispensing what I call the illusory reasons for either borrowing money or not borrowing money. I hear these reasons from CFOs. I don't think they stand up to scrutiny, but they're around a lot. Here are the two reasons I've heard for borrowing money that really don't stand up to scrutiny. The first, and this I hear from real estate developers and private equity investors, big users of debt. And here's the argument, that debt will increase your return on equity on an investment or a business, and therefore increase the value of your equity. Now, half that statement is generally true. It is true that in most businesses, borrowing money, or most projects, borrowing money will increase your return equity. Why? Because you have less equity invested, and even though you have lower net income, your return equity will go up. But that might not translate into a higher value of equity. Why not? Because when you borrow money, your equity gets riskier, and that higher risk will translate into a higher cost of equity. What drives value is the difference between return equity and cost of equity. I will contend that if you have a neutral project, one where the return equity is equal to cost of equity, borrowing money on that project will leave it a neutral project, increasing both the return equity and the cost of equity. A second reason I've heard for borrowing money is that debt is cheaper than equity. And technically, it is. In fact, if you look at my earlier sessions where I looked at cost of equity and cost of debt for businesses, you will notice that my cost of equity is consistently higher than the cost of debt. Sounds like a no-brainer, right? The cost of debt is lower than the cost of equity. Let's go out and borrow money. Well, not so fast. While debt is cheaper than equity, as you borrow money, you will increase both the cost of equity and the cost of debt. In a strange way, you can actually reduce your cost of capital sometimes, but sometimes you can increase your cost of capital as you borrow more money. So the notion that debt is cheaper than equity and therefore you should keep borrowing money doesn't hold up. On the other side, I've seen two reasons given by businesses for why they don't borrow money. One is if we borrow money, that will lower our net income, make us less profitable, and therefore less valuable. Now, half that statement again is generally true. As you borrow money, you create interest expenses, and interest expenses do lower your net income. Why doesn't that necessarily lower your value? Because you also have less equity at play. In fact, that's why in companies, we don't focus on net income, we look at earnings per share. And as you borrow more money, you don't have to issue as many shares, your per share earnings might actually go up. I've heard some CFOs also argue that equity is cheaper than debt. How can that be? Well, if you look at the explicit cost of debt, it's interest expenses. You compare to the explicit cost of equity, which actually there isn't one. But even if you think of dividends as an explicit cost, dividend yields are much lower than interest expenses. In fact, if you don't pay dividends, with this view of the world, equity is cheap or even free. So the argument is, let's go out and raise equity because it's cheap or free. You can already see that the limit of that statement is that it doesn't factor in the true cost of equity, which is implicit. People, when they invest in the equity in your company, are not just doing it for the dividends, but also for price appreciation. And the cost of equity is supposed to capture it. So these are illusory reasons, but you see them used in a lot of companies for either borrowing money or not borrowing money. So let's look at the real trade-off that determines how much you should borrow. The biggest reason for borrowing, and if you strip this away, much of debt falls apart, is the tax benefit. Governments that complain about companies borrowing money are responsible for companies borrowing money because they've written the tax code to encourage borrowing. In what way? When you have interest expenses on debt, they tend to be tax deductible in much of the world. Cash flows to equity have to come out of after-tax cash flows. So dividends have to come out of after-tax cash flows. That's a big advantage of debt. And the higher your marginal tax rate, the greater the tax benefit to borrowing. In some businesses, especially mature business with a lot of cash flows and earnings, there's an argument that using debt can make managers more disciplined. In what way? Well, if they don't have the debt, they can be sloppy and get away with it. A bad project can be buried under those earnings and cash flows. By forcing these businesses to borrow money, you can make managers think about the consequences, because now if they take bad projects, they might actually get into trouble. By getting into trouble, they might not be able to make the interest expenses. They might lose their jobs. It's an extreme way of getting somebody's attention, but debt can help to discipline some managers in the decision-making within companies. Tax benefits and this discipline. What are the big minuses? Well, by borrowing money, increase your likelihood that you will default. You're saying, what if I'm a really big company with a lot of earnings? Even at those companies, borrowing money will increase the probability of default, maybe from 0.01% to 0.03%, but it'll always go up. The bankruptcy cost, or the expected bankruptcy cost, is the product of that probability and the cost of bankruptcy. What's the cost of bankruptcy? First, this is the deadweight cost. If you go bankrupt, you end up in the legal system that sucks up your resources, legal costs, and paying for lawyers. But there's another cost that I think is much more insidious. As you borrow money, if people think you might default, you might get into trouble, it affects their interactions with you. Your customers stop buying your products. Your suppliers start demanding cost. It's called an indirect bankruptcy cost. But that's something you got to factor in as you borrow money. What is that expected bankruptcy cost? You also have what's called an agency cost. If you think about it, the two claim holders here, debt and equity, have very different types of claims. Lenders get a fixed claim, a contractual claim. They get no upside from taking risk. Equity investors get all of the upside. So already you can see that there's a conflict of interest. And the way this plays out when you borrow money is lenders factor in this conflict of interest in the form, they write in covenants. They restrict you from what projects you can take, how much you can borrow, how much you can pay in dividends. And to the extent that those restrictions start to bite, you might have to, as a business, decide not to borrow money so you can have more freedom or flexibility. Tax benefits and added discipline, bankruptcy costs and agency costs. That is the real trade-off. So businesses should be making their debt decisions based on that trade-off. But in the real world, there are frictions that can cause companies to deviate from the right mix of debt and equity. First, we talked about the cost of bankruptcy, how worrying about bankruptcy will lead companies to borrow less money. But if you live in a system where you're protected against bankruptcy, why? Because governments step in and bail you out when you're in trouble, or stop banks from going after you, or you have a legal system that doesn't enforce bankruptcy, companies will borrow too much money. A second reason for borrowing more than you should, given the true trade-off, is maybe you get debt at a subsidized rate. What does that mean? There's a fair market interest rate at which you should be borrowing money, reflecting your default risk. But let's say that somebody out there is willing to lend to you at a rate below that number. That somebody might be the government, it might be impact investors. If that is the case, you will choose to borrow more money than you should because you're getting subsidized debt. And there's a third scenario where companies will go out and borrow too much money. Remember we said there's a choice between debt and equity? Let's say your equity is held by founders and families and insiders, and they don't want to give up control. Even though the right choice for them might be to raise equity, they might choose to borrow money because they value control more than health, financial health. So they will be borrowing money not because it's the right choice for them, but because it allows them to maintain control. So those are all reasons why you might see more debt than you should expect to, given the real trade-off. There are also reasons why you might see less debt. One is we talked about covenants and restrictions. In some cases, where those covenants are very restrictive, companies might choose to borrow a lot less. One reason US companies might feel more willing to borrow money than many companies outside the US, you have the choice of raising debt through the issue of corporate bonds. And corporate bonds tend to come with fewer covenants than bank loans. But if you're in a system, a market, where the only way you can raise money is to go to a bank, and banks put very restrictive covenants on you, you might choose not to borrow money because you value flexibility. The second scenario is a tricky one. Remember that you raise equity at a market price, but let's say the market is become over exuberant with your stock and is pricing it at 3 times what it should be. Do you see the temptation you're going to have to go out and raise equity even though debt might be a better choice for you because equity is overpriced? And finally, there might be scenarios where you have to use equity because you're regulated or restricted from borrowing money. There are sectors where there are regulations on how much you can borrow. And if you hit those caps, even though those caps might not be the right caps for you, you're actually capped at too little debt, you have no choice but to raise equity. So the illusory trade-off, the real trade-off, and the frictional trade-off. Now, if you think about optimizing tools, there's a familiar tool that will come into play. Remember I described the cost of capital as a Swiss Army knife of finance? It comes into play when you try to decide what the right mix of debt and equity is based on the real trade-off. The cost of capital is a weighted average of your cost of equity and your cost of debt. The cost of debt, of course, the risk-free rate plus a default spread. The cost of equity comes from the risk-free rate and equity risk premium and a measure of relative risk. So here's what happens as you change your debt ratio. As you increase your debt ratio, it is true you're replacing more expensive equity with cheaper debt. But as you borrow money, your cost of debt goes up. Why? Because banks see more risk in you because you borrowed more money. Your cost of equity goes up because your equity investors get a residual claim that becomes more volatile. The net effect is going to determine your cost of capital. So initially, borrowing money might lower your cost of capital because the replacement effect, or where you replace more expensive equity with cheaper debt, is greater than the effect that the debt has on the cost of equity and the cost of debt. But there will be a tipping point where the costs of borrowing money in terms of the cost increase in the cost of equity and the cost of debt will be greater than the benefit you get by replacing more expensive equity with cheaper debt. That is your optimal financing mix if you think purely in terms of the real trade-off and thinking in terms of the cost of capital as a vehicle that delivers that real trade-off. So now that we've covered the trade-off and debt and how to optimize your debt equity mix if you choose to, let's look at what companies actually did. So in 2024, I took all publicly traded companies, and by now you should be familiar with my sample of 47,810 publicly traded companies around the globe. I do have all the numbers restated in US dollars so I can compare and aggregate across. And I look at the dollar value of debt and equity in 2024. And in the top panel, you look at the breakdown by sector and the bottom by region. So let me very quickly go down my breakdowns on debt and equity and the changes that you see reported in this table. On debt, you will notice a gross debt and a net debt. Gross debt is all interest-bearing debt and lease debt. Net debt is that number net of cash and marketable securities. So in 2024, collectively, global companies had $72.9 billion in gross debt, but only about $50.8 billion in net debt, the difference being the cash balance. With equity of a market value of equity, because these are all publicly traded firms, that's a market cap, which is significantly higher than the book value of equity. So if you look at the collective market value of equity of firms, it's $123.6 trillion. The collective book value of equity is about $57.4 trillion. I also looked at the changes in 2024. With debt, I looked at the debt repaid. Collectively, global companies paid $29.9 trillion in debt was repaid, but they also raised $31.3 billion in new debt. So the net debt was actually a cash inflow of about $1.3 trillion. For the equity, cash returned in the form of dividends and buybacks was $4.3 trillion. That's cash returned to shareholders, but collectively, global companies issued about $700 billion in new equity. Now you'll notice I've separated out the financials. Why? Because financials are an odd beast when it comes to debt. Unlike the other companies where debt is a source of capital, with banks, investment banks, even insurance companies, you could argue that debt is not a source of capital, it's raw material. So if you take financials out of the equation, you do get, I think, a clearer sense of what companies did in 2024. It doesn't change the picture overall, but it gives you a much better perspective on how much has been borrowed, how much got repaid, and what happened to debt and equity during the course of the year. So that's by sector. I also broke down debt by region, and I did this for just the non-financial service companies. Otherwise, you get parts of the world where you have more banks look like they have more debt. So if you look across parts of the world, again, you see big differences in debt and equity, and in terms of the difference between market value of equity and book value of equity in much of the world. So if you look at market value of equity and book value of equity in parts of the world, in almost every part of the world, market value of equity exceeds the book value of equity. But they exceeded by more in some parts of the world than others. So if you take the US, for instance, the market value of equity is $51.4 trillion. The book value of equity is less than 10 trillion. Now, we'll talk about why those divergences might be happening, but you see the dollar debt values. Now, as you look at the dollar debt and equity numbers, and you try comparing across sectors and regions, you're very quickly going to run into a problem, which is they're not scaled to something. Is 51, if you look at the US debt, 9.6 trillion, looks like a lot of debt, but the US is also the biggest market in the world. So one of the challenges with debt is how do you scale it? What do you scale it to? And as I see it, debt can be scaled to a lot of different scalars. You can scale debt to the total capital in the firm. That's called debt to capital. That capital can be stated in book value terms or market value terms. You can scale debt to operating cash flow, a very rough measure of operating cash flow. The most common one you will see is debt to EBITDA. So if you have a lot of debt relative to EBITDA, that number is going to be a high number. You also can focus in just on interest expense and look at what you have in earnings before interest and taxes, operating income relative to those interest expenses, called the coverage ratio. And as I mentioned earlier, you can look at gross debt or that debt net of cash, net debt. So you can already see there are multiple measures of the debt burden depending on what you scale it to. So what I did just as an exercise to see what the numbers look like was to take my sector and region numbers and state them as scale numbers. So in this table, in two panels, you see the debt to capital ratios in book and market. And then I've estimated the divergence between the debt to capital, the book and the market numbers for both gross debt and net debt. Let's say communication services. Communication services raise 45% of their book capital, so the debt plus book value of equity from debt, if you look at it as gross debt, but a slightly smaller percentage, 39% if you look at net debt. But you look in terms of market value, especially because you're replacing a small book equity with a large market equity, you can see that the debt ratios were lower. And if you compare across sectors, and again, financials I think are a beast of their own, you can't compare them to anything else. If you look at the non-financials, the most highly levered sectors, if you look at debt to capital, happen to be utilities and real estate. It's interesting, though, that real estate is the only sector where market debt ratios are actually lower than book debt ratios, because real estate might also be the only sector where assets get marked up to market in much of the sector. So that might explain why it stands out against the rest of the market. So you can see the debt to capital ratios vary across sectors, and the least levered sector on a debt to cap ratio, probably won't surprise you, is technology. Now, if you look at across regions and you look at the most heavily levered and the most lightly levered parts of the world, the part of the world that has the highest debt ratio, and you can compare across, when you compare across, happens to be China and what I call small Asia, but it's not meant as an insult to Asia. It's Asia without India, China, and Japan. Latin America actually stands out above them in terms of debt ratios, both gross and net debt ratios. So as you look at debt to capital ratios across regions, you can see it varies across the world. And while there is this conventional wisdom that the US has a lot of debt, that is true on a book debt ratio. But if you look at market debt ratios, the US falls back to the low end of the scale. So depending on whether you look at book or market, you can make different judgments. But the clear choice across the world is, that there are variations in how much debt companies around the world use. So with that, on the debt to cap, let's look at the debt to EBITDA and the interest coverage ratios. Again, if you focus debt to EBITDA, remember the higher the number, the more debt the company has, and you take financials out. Real estate is the most levered sector on a debt to EBITDA basis. Okay. But utilities also are pretty high, $5.11 of debt for every dollar of equity. So you look across sectors, again, real estate and utilities stand out as the most highly levered. Technology and energy, and I was a little surprised by energy, have the least debt. Partly because the big oil companies, and because these are aggregated values, they carry a lot more weight, tend to be lightly levered. When you look at debt and EBITDA by region, China stands out as the most highly levered part of the world, with $4.58 of gross debt for every dollar of EBITDA. And in terms of debt to EBITDA, it stands out as the part of the world which should worry the most about debt. You look at interest coverage ratio. Here, the lower the number, the more worried you should be about debt. You can see again China and Canada towards the low end of the spectrum, as is Latin America. But the US actually comes out as reasonably good on all of these measures. Again, fighting against the conventional wisdom, the US companies have gone out and borrowed money like it's going out of style. So when you compare debt ratios, whether it's debt to capital or debt to EBITDA and debt to interest coverage ratios around the world, you're getting a sense of the variations of the use of debt around the world. So let's step back and look at why it might be that in different parts of the world there is more debt in some parts and less in others. And I'm going to focus in on the two biggest drivers, tax rates and default risk. In this picture, which is a heat map of tax rates, I've looked at marginal tax rates in companies around the world. So this comes out of the tax code. And as you can see, much of the world is actually between 24 and 28%. So you look at the US, Canada, much of Europe, 24 to 28%. The red parts of the world are the parts of the world which have the highest tax rates. Corporate tax rates still above 32%. Remember, until 2017, I'll talk a little bit more about this, the US was firmly in that red zone with a marginal tax rate close to 40%. But the red parts of the world now are much of Latin America and parts of Africa. There are parts of the world with low tax rates. Much of Eastern Europe falls in there, as does Indonesia, parts of the Middle East. But looking across the world, increasing the world is converging to a marginal tax rate between 24 and 28%. And it's very difficult to stay out of that zone when the rest of the world is moving towards that zone. Incidentally, if you look at Western Europe, much of Western Europe has 24, 25, 28% tax rates. There's Ireland standing out, and Ireland has used its lower tax rate as a way of drawing companies to itself. So that's a driver of a great deal of tax of borrowing, because tax benefits, after all, are a big reason to borrow money. Now I want to focus in just on the US. As I noted, until 2017, the US had one of the highest marginal tax rates in the world. A marginal tax rate of 40%, federal tax rate of 35% plus state and local taxes, you very quickly got up to 40%. The 2017 Tax Reform Act did lower the marginal tax rate for the US to 21%. Now, holding all else constant, I remember when I was teaching the class in 2017 talking about how now debt should be a less attractive way of raising capital for US companies because the tax benefits had decreased. Now, we now have enough data since 2017 to see how US company debt has changed since 2017. If you look at the dollar debt has continued to rise. So you're saying, well, now what's going on? If the tax benefits of debt are lower, why aren't companies borrowing less money? Well, companies also scaling up. They have a lot more EBITDA. And the two ratios with scale debt, you can see that the debt to capital ratio, which pre-tax reform, pre-2018 was 24.59%, has dropped to 20.27%. But that's kind of a murky measure because it's also affected by the market value of equity. You look at debt to EBITDA, 3.3 times EBITDA, pre-change 3.17. Well, I'm not going to overreach here. Clearly, there's a little less debt, but not by enough that you can look and say a big drop off. I mean, I think one reason is debt policy is slow to change to tax rates. And second, the 2017 Tax Reform Act was not permanent. In fact, it expires at the end of 2025. And in fact, its fate was very much up in the air until the last election, which might have sealed its extending for another 10 years. So part of it might be companies waiting to see if this is permanent. So let's see if 2025 sees a bigger drop off in debt, but companies are slow to change. So that's the tax rate side. Let's look at the other dimension at play, which is default risk. As I noted earlier, when you borrow money, you increase your chance of default. And one of the most visible proxies of default risk is a bond rating. So I looked at the distribution of bond ratings from S&P across all rated companies at the start of 2025. There are only 2 AAA rated companies left in the world. If you go back and compare over time, there were dozens of AAA rated companies 30, 40 years ago. Now there are only 2, Microsoft and Johnson & Johnson. So it's rarer and rarer to see AAA ratings. The middle of the distribution obviously is BBB, investment grade, but you can see a substantial number of companies have below investment grade ratings. So that's a distribution of bond ratings. Now, I was also interested in default risk and rates over time. So I looked at 2024 and how it measured up against history, both in terms of the number of defaults. There were 145 corporate defaults in 2024, and that was down from 153, and a 3.5% default rate, which was slightly down from 3.6% in 2020. So not much change in 2024 relative to 2023. Both those numbers, though, were higher than they were in 2022 and 2021. So we'll go back and look. And 2020, of course, was an outlier. That was the year, of course, of COVID. So you can see the numbers shift over time. And during crises and during recessions, those numbers tend to increase. Now, if you step back and look at default rate and default risk, it shows up as a default spread in markets, a price of risk in the bond market. If you remember in my data update 2, I looked at the price of risk in the equity market, the equity risk premium. In my data update 4, I looked at the price of risk in the bond market, which is the default spread. And here I've brought those two into the same graph. Why? Because I want to see when people in one market panic and worry, do people in the other market panic and worry? You'd think they would, right? It's often the same people. In this graph, you can see for much of the period, when equity risk premiums go up, default spreads go up. And when equity risk premiums go down, default spreads go down. Well, 2024 was a typical year, if you define that as typical. The equity risk premium went from 4.6 to 4.33%, as chronicled in update 2. And the BAA, the default spread on an investment grade bond, went from 1.62 to 1.42%. So basically, it went down as well. So both the debt and equity markets saw a decline in the price of risk. one final aspect of debt before we kind of let this topic go. We've talked about debt as this aggregated value. But debt can take many forms. It can be long-term or short-term. It can be different currency. It can be fixed rate or floating rate, straight or convertible debt. In fact, as we go through time, more and more choices open up. And often companies wonder what the right kind of debt for them is. And they make the mistake of asking a banker or a consultant what the right kind of debt for them is. Why a mistake? Because it's not because bankers are bad people, but because they have their own self-interest. The best debt for you as a company is the debt that best matches your assets. What does that mean? If your projects are long-term, you should take long-term debt. If your project delivers cash flows in euros, your debt should be euro debt. If you have a lot of pricing power, in other words, your earnings tend to go up as inflation goes up, you're a much better candidate for floating rate debt. Why? Because by matching your debt up to your assets, you reduce default risk and your cost of debt. So the right kind of debt for you, for a company, is the debt that best matches assets. Now, in individual companies, you can see whether there's a mismatch. I can't see this across almost 48,000 companies, but I can give you what the debt details look like by sector and region, where I break down debt first into lease debt as a percent of total debt. And you can see that it varies widely across sectors. So healthcare and communication services and consumer discretionary, you see that number is a high number. Utilities, it's a very low number. So the amount of lease debt varies across sectors. I also looked at the percentage of debt that takes a form of corporate bonds as opposed to bank loans. And again, big variations across sectors. So there are sectors where the percent of debt, like healthcare, where it's 66% of the debt is corporate bonds. But you also have sectors like industrials where it's only 35%. Again, variations. And finally, if you look at the percent of debt that's floating rate debt, again, varies widely across sectors. Now, part of the variation across sectors might be explained by variations across regions. So you look at the percentage of debt that's lease debt or corporate bonds and floating rate debt by region. You can see that the US has the highest percentage of lease debt, corporate bond debt, but the parts of the world that have the highest percent of floating rate debt are in Eastern Europe, India, Latin America, perhaps reflecting the desire of lenders to make their interest rates much more sensitive to changes in inflation. So again, wide variations across sectors and regions. Is the debt mismatched? Again, looking at the aggregate numbers doesn't answer it, but I'll make a guess. I would assume that there's a lot of mismatched debt, less in the US where companies have the options of refinancing much more easily. There's a capital market and a corporate bond market that's flexible. And more mismatches in parts of the world where you're predominantly reliant on bank debt for your debt. Look at Africa and the Middle East, for instance. Almost 74% of the debt comes from banks, and they set the terms. So I'll wager there's a lot of debt out there that's waiting to get restructured as options open up. So what's the bottom line? As you know, when interest rates in 2022 went up from decade-long lows, there were two big questions. One is, the higher interest rates, are companies going to borrow a lot less money? And the other was, as interest rates have gone up, you're going to see a lot more default across the world. Now, I think we're only 2 years in, 2023 and 2024. It's still tentative, but I think we have some answers. The dollar debt has not declined around the world because of higher interest rates. Companies have continued to borrow even at the higher rates. And while the number of defaults might have gone up, in terms of default rates, we're looking at rates well below what you'd have seen in a recession. So far, at least, companies seem to be handling the higher interest rates fairly well. But you know what? The true test will come, right? If we have a global economic showdown or recession, then we're going to see whether companies can sustain the debt they have if interest rates stay at 4%, 5%, 6% in dollar terms in the US, or even higher in the rest of the world. So I think that's going to be the big question is, are companies really healthy? Are they looking okay because the economy is still carrying them along? I hope you found the session useful, and I thank you very much for listening.